Hello and welcome to the Monocle Banking Podcast, curated by Monocle Solutions. I'm your host, Michael Avery, and today we're doing the due diligence on the world of mergers and acquisitions, a topic that's been quite the roller coaster in recent years, especially here in South Africa. If we look historically, M&A activity has been on a notable decline since 2008 due to a myriad of factors. We've had the financial crisis, we've had the state capture revelations, the global pandemic, increased geopolitical tensions, then the rise in inflation and the commensurate rising interest rates. All of that have contributed to a very challenging environment for deal making. However, with South Africa's newly formed government of national unity, there does seem to be a glimmer of hope on the horizon. The Reserve Bank's efforts to curb inflation are certainly showing results. The domestic currency, the rand, is finding some support, and there is a renewed spirit of partnership between the private sector and government. So what does this all mean for M&A activity in South Africa and the region? To help us unpack the outlook for deal making, it's great to be joined by two distinguished guests. Firstly, we've got Ruven Naidoo, who's head of M&A at Investec, and Marc Ackermann, head of advisory at the Zebra. Marc, Ruven, welcome to the podcast. Ruven, maybe you can just kick us off by telling us a little bit more about your role at Investec and how you came to specialize in corporate finance and M&A.
Thanks, Michael, and thanks for having us on. So my role at Investec, as you said, is head of M&A for Investec South Africa. So that encompasses all of our M&A activities within the country and also north of the borders where we act. I started in M&A right at the beginning of my career. So straight out of university, I went into investment banking, and I've been active in the corporate finance world here in South Africa and sub-Saharan Africa ever since then. So that's now going on 15 years, and it's been quite a journey. Some of the highlights on the journey you've already talked about. It sounded like a lot of things that we've been through in the last few years, but it's kept things exciting, and we now look forward to this positive path that we're on.
Absolutely. Marc, how did you get involved in the cut and thrust of deal making?
Michael, I've got a career that spans close to 2 decades in investment banking. I initially qualified as a chartered accountant, always had a passion for finance, corporate finance and mergers and acquisitions. So right from the get-go, I had the fortunate benefit of knowing exactly what stream I wanted to get into right from the start at university level.
Let's dive in because, as I said in my introduction, the environment is very interesting. So let's maybe just start with the macroeconomic factors at play at the moment. And given what we've seen, this continued moderation inflation, the anticipated interest rate adjustments across sub-Saharan Africa in lockstep with the Fed, how do you see these macroeconomic changes influencing deal making in the remainder of the year and into 2025, Ruven?
Yeah, Michael, there's as you started out when you introed this conversation, we've been through a lot. And as you're going through your list, as I say, it was sort of surprising to remind ourselves all the things that we've come through in the last few years. And now finally we're at the point where, things are starting to look a lot more positive. And I think, the improving cost of capital that's on the horizon is certainly one of those things. Fortunately, that's now been cited by the market and people are planning for that. And so what that's translated into is a lot more activity at a preparation stage and at a contemplation of deal making stage. So, within our universe, we saw these green shoots coming out in the boardrooms of South Africa earlier this year as people anticipated a lot of these positive changes. But that being said, there are other factors that bring to bear in this situation as well. So it's not just a cost of capital discussion, it's a South Africa Inc. discussion, the positivity around that, our own constraints that also moderate the activity. So we certainly expect the activity to be heightened going forward. But that also depends on how we come through certain of the wait and see events around South Africa Inc. What I would say, and this is a big positive for us, is that our global prominence has increased materially over the last, call it 3 to 4 months, as people started seeing the big headwinds like our load shedding problem starting to look like it's being resolved, our GNU coming together and holding, our Reserve Bank doing a good job at taming inflation. All of those things have put South Africa back on the map, and we're certainly starting to see international interest in South Africa increase dramatically relative to where it's been, let's call it a year ago.
It's an interesting point, and Marc, to bring you in on that, for the first time in a long time, it must have been about a month ago, I was watching Bloomberg, and one of the talking heads, when being asked about their global capital allocation towards EMs, said, and unprompted, that South Africa is starting to look encouraging again, and they're starting to reweight their allocation to South Africa based on what they've seen. All of those factors that Ruven mentioned, load shedding, the GNU, potentially declining interest rates, and a fairly resilient rand, given what we've seen in Nigeria, what we've seen in Egypt, with the devaluation of those currencies in very large African economies. South Africa certainly stands out. Would you go along with that? And are there particular sectors then that might benefit more than others from these changes in South Africa?
Michael, I think I would certainly agree with that. We've come from a period of sustained and protracted high interest rates and pedestrian growth in South Africa. And certainly it feels a lot more optimistic as we sit here today. The outlook looks a lot brighter. I think historically it's been very difficult for investors and corporates to price risk in the environment because there's been so much uncertainty. And there's certainly an increased element of improvement in the understanding of the outlook and therefore a greater ability to price that into any transaction. So we think that there's certainly going to be an increase in activity. We're going to see an increase in activity doing deals in both the public and private markets perspective. We're already seeing a pickup in activity as we sit here today, and we expect the momentum to increase even further going into 2025. We must not forget that, albeit that we've had a few nameable corporate failures in the recent past, we do broadly still have a set of world-class management teams that really stand back for nobody on a global scale. And the attractiveness of that management expertise, skill, and underlying business opportunities and operations is really attractive, even in particular when considering the current valuation levels in context of international peers. I think the sectors where we see increased activity, certainly with the outlook of an improved South African consumer through the reduction of interest rates and the two-pot retirement system, we see the consumer and retail sector continuing to remain resilient. And the broader infrastructure theme is a big one for us. The increase in private and public partnership, which you mentioned earlier on our discussion. I think traditional infrastructure, road, rail, and port, renewables, energy transition, power infrastructure, and digital infrastructure alike, we really are seeing a massive uptick in interest across those sectors.
As we're recording this conversation, I was reading in Business Day this morning the fact that the IFC is now looking to pull the trigger on some investment into South Africa's grid infrastructure by way of example, because it's encouraged by what it's seen from government. And we know we need to invest quite heavily in the grid if we're to unlock further potential IPPs, particularly in the renewables space. Ruven, would you say those are pretty much the hot sectors as you see them?
Michael, what we've been fortunate enough to experience over the course of this year is quite a broad set of M&A interest and activity. So sectors that were, I would say, reasonably muted over the last few years have started to come back to life. And we're seeing renewed M&A activity in the more traditional sectors. So that's the likes of your general industrials, manufacturing. And those sectors have come back, including mining. Whereas when we think through COVID, the sectors that really shot the lights out were the tech-focused sectors. So now we're starting to see that base improve. And that's an indicator of confidence in the economy as a whole. So that's something that we're quite pleased to see, that broad-based shift towards M&A.
I was interested by the SAVCA survey recently pointing to private equity fundraising being at a 13-year high. And that's obviously usually a very encouraging forward-looking indicator that general partners are managing to persuade their LP investors that they see a deal suite and a deal pipeline opening up at very attractive valuations. Marc, how do you see it? Because there's a lot of dry powder in the private equity space, but there has been shall we call it a noticeable hesitation on big deals. I don't know if it was the Edcon deal that just kind of burned too many fingers. How do you see private equity activity evolving through the course of this year and into next?
Michael, I think that's right. I think private equity funds are a lot more circumspect when it comes to the larger deals, because obviously the required equity check that's required to be deployed. Because really we operate in a market that has a rather prudent approach to financial leverage in buyouts. I think in recent past, there's been a build-up across the private equity owned portfolios in the need to monetize investments and to show evidence of return of capital to investors. So we're expecting a continued increase in financial sponsor and private equity activity that would support that narrative and further evidence that theme. But going forward, given the capital raises that you have mentioned, we certainly feel that those capital raises are going to be a lot more focused on themes which we've mentioned around infrastructure and the broader macroeconomic development of the landscape.
Yeah, it was interesting to bring you in, Ruven, at the BATSETA conference recently, how many private equity infrastructure funds were presenting and obviously pitching their funds to institutional investors like pension funds as this opportunity set opens. And also, as you know, we've seen Regulation 28 change the allocation limits to the asset class. Very interesting just to see how the private equity landscape is evolving. Do you see any specific strategies that PE firms might be adopting in what is a slightly more hesitant market on the big deal side?
Michael, I think that the way PE firms are, navigating the market currently is that, as we've discussed, there's certainly cost of capital reduction on the horizon, and we've spoken through the renewed optimism around the economy. And so what that does is it brings in a suite of opportunities into the right return profile for private equity firms. So private equity firms are now able to consider a broader set of opportunities than they may have considered a year ago. And so I think that's really the change in their perspectives, because these firms have always been and had the desire to invest in the country. All they needed to do was to find the right opportunity that met their return requirements. And as the environment around us shifts, the amount of opportunities that fit into the suite of returns that these firms would want to achieve has now increased.
That said, I mean, I know the environment forward-looking does seem to be a lot better, but it still feels like there's a lot of pain in the system. And, Marc, if you look at the rise in business rescues, for example, AutoZone, Westpac, Ellie's, PetZone, I mean, several big names or biggish names in the some kind of mid-cap space have entered business rescue. So what do you think is going to drive M&A activity the most? Is it going to be distress-driven deals still, maybe consolidation, or is it something else?
Michael, I think, you've mentioned a few business rescue situations. We see that as being less of a direct link to M&A. A few years back, we took on the initiative to build out a restructuring advisory practice in business because we were seeing the increased need for improved capital structuring and optimization. And that team has been incredibly active in the space, and it's really trying to be the preventative to business rescue and insolvency. So we've certainly seen a lot of activity there. I think in terms of the broader key drivers for M&A, we certainly see continued portfolio rationalization. So corporates and private equity owners and investors focusing on core underlying operations. We've seen a continued increase in financial sponsor and private equity-led activity, which we've mentioned previously in this discussion around the need to monetize investments and show evidence of return of capital to investors. And then in certain sectors, we are seeing continued increasingly focused around strategic consolidation, and cross-borders becoming more prominent as well. And that's both inward and outward. With the change in the macroeconomic landscape, political landscape, having a better sense of being able to price risk, there's been an increase of inbound from offshore, you want to call it suitors or corporates or investors looking to deploy capital into our markets. And then in the same vein, from a South African perspective, looking to diversify earnings offshore. And it's not in the same spaces where we've seen some examples of the past of some corporates betting the house, so to speak, internationally, and then coming across it. It really is on a more focused basis that's a lot more bite-sized and focused on new markets that are strategic interest, or alternatively where businesses are looking to improve supply chains.
Yeah, supply chains is a very interesting one. And inbound, I was chatting to Roger Foster, the CEO and co-founder of Airlink, about the Qatar inward equity investment of 25% into the airline. Really a significant vote of confidence into our local aviation industry, obviously capped because of regulations. Ruven, just building on that, then, outbound, which countries or regions or sectors might stand out then for M&A opportunity for South African corporates looking to do deals outside of South Africa?
Michael, the attitude of South African corporates to outbound M&A deals is varied. And so across sectors, I would say that there is strong focus on diversifying the earnings base of the best placed South African corporates. Many of our corporates in their sectors are local champions and have achieved, strong prominence in their sectors and are already market leaders. So necessarily for them, they think about how they can grow their business. And so they do take a global lens to the opportunity set, but that is naturally guided by a few factors. And I think high on that list is cultural integration and the ability to operate in markets where they feel there's a close cultural fit. Also looking at markets where their expertise is relevant. So it's certainly not a strictly financial decision. There's a lot of soft elements that go into picking those markets. What I am pleased to say is that that's not unique to a specific sector in South Africa. There are many corporates who have achieved success in South Africa and have now turned their sights into assessing M&A opportunities globally. And those opportunities range in size as well, depending on the nature of the corporate who may want to test out markets or who have already tested out markets and then looking to further their scale. So it is a varied approach to global expansion.
Absolutely. But, balancing, as you say, some of the quantitative data analysis when you look at a deal and, how value accretive it could be with some of the qualitative aspects like corporate culture, which really does play an outsized part when you're looking to do deals outside of South Africa. And I think very often in the past, perhaps that's where transactions have been tripped up, heading into markets like Nigeria and others where we've seen a litany of unsuccessful M&A. Marc, when you look at it, what major risks building on that then or challenges could face deal makers, especially in this context of, wanting to take advantage of opportunities, but where the macro is still, I think, quite difficult to call. I know the market's banking on the Fed cutting rates next month, but there are still questions about the underlying health of the US economy and whether or not it is indeed going to be a soft landing. So what do you see as the big risks?
Michael, I think it's anything that's a shock to the system. From a South African perspective, if we don't see delivery of public policy, if the GNU doesn't work, I think that creates a major challenge for deal makers. Any increase or substantial increase in geopolitical risk, I think there's an expectation around what that looks like in the short to medium term, but that may change. And the US may play quite a significant role in how ultimately that plays out. So really any shock to the system where investors have less understanding or an increase in uncertainty creates volatility. And in a volatile environment, it's incredibly difficult to both price and close out any transaction. So I think that would be, the subset of the major challenges for us as we look across the deal-making landscape going forward.
It was interesting chatting to John Picard, a very famed value investor, about how difficult it is often to change perception from positive to negative or the other way around, and how many data points one needs before that confidence is cemented. Ruven, just building on that, you said earlier that there's certain wait-and-see events for this government of national unity to further solidify and cement confidence. Could you maybe just share on what some of those might be and how you're advising clients to mitigate these specific risks as they relate to South Africa and what is a very new and very fragile coalition at a political level?
Michael, so the wait and see, I think, is on delivery of promises and delivery of expectations. So what we're really looking for from the GNU is to see a delivery of execution of their plan for South Africa. I think what we all acknowledge is that we've got the building blocks in place as a country to really move forward. So differentiators for South Africa relative to other emerging markets is our legislative framework, our financial system. These are all incredibly powerful levers that we have. And what people are expecting from the GNU now is to really execute on government's role in the economy, which is effectively to promote growth and to enhance the success of South Africa. So as we start to see evidence of that come through, I suspect that optimism is going to be on a J curve upward. The more of it you see, that optimism is going to increase exponentially. And with that increased optimism, I think to your point, there's going to be less and less needing to convince people that we're moving ahead now, and people are going to start acting in accordance with that.
And that creates that virtuous cycle that hopefully will really propel that next leg up. One could probably add to that improved credit ratings, which further solidify confidence. From what I hear from conversations with the Financial Intelligence Center, they're fairly certain we'll get off the grey list by June next year. And then declining interest rates, all of these very positive for the broader deal-making environment. Marc, from a deal-making perspective and structures, are you seeing any creativity when it comes to deal structuring? You're always going to see valuation gaps. And certainly in a market where we see in the listed space, so many South African counters trading below their net asset value or intrinsic value, there's lots of opportunity. How is this feeding into deal structuring? Are we seeing maybe increased JVs or issuing scrip more, or club deals becoming more common as debt does remain expensive?
Michael, with the so named valuation gap, there really has been a period now, and we expect it to continue in the short to medium term, of a focus in risk and reward sharing between buyers and sellers, which would certainly support better alignment between the parties. Some of those structures that become more prominent are things such as earnouts or vendor or seller financing into transactions, or joint ventures that allow for parties to bridge the valuation gap. We've been through a period now, I'd say, in our observation of the last 12 to 18 months, that has really been catalyzed from the need that came out of COVID to be a lot more creative in deal structures. And we expected that to continue in the short to medium term.
Ruven, would you have anything to add from that perspective around deal structuring and what you're seeing in the market, or maybe an example of an innovative structure that you've seen recently?
Michael, I think the broad strokes of that answer captures what we see in the market. The concept here is risk sharing between the buyer and seller, and that can play out in different ways. It can play out, as you've said, or as Marc has said, through deferred earn-out mechanisms. It can also play out through legal agreements in the form of reps and warranties, depending on what the seller is willing to warrant. And then the other part that has become more prominent is consortia deals, where parties mitigate their own risk through reduced equity exposure. And so all of those factors are in play now, and I think from a seller's perspective, there is a lot more tolerance to give buyers comfort on what they need in order to bring those expectations of buyers and sellers together.
And then, Ruven, how does that then feed into the process of due diligence? And what would you say is becoming more of a focus in the due diligence process, given that there's going to be this risk-reward sharing between buyers and sellers? One needs to have a fair degree of confidence into future projections of earnings, for example. How is this all coming and feeding into the due diligence process?
That's a great point, because whilst commercial, due diligence has always been the focus of deals, and commercial in does it make financial sense, and do we believe in this business? What's becoming more and more apparent in deals is the sellers are taking a lot more time to prepare their views on selling a business, because the need to convince the buyer that what the seller sees from a future expectation perspective is rational and reasonable is heightened. And the reason it's heightened right now is because we're in an environment where there's a very positive outlook, but the degree of positivity on that outlook differs between people. And so in order to convince a buyer that, your view on being positive is, grounded and based in facts, there's a lot of prep work that goes into that to construct that argument well so that it's well received from a buyer. And so that I would say is the commercial overlay in terms of preparing well in advance. The other factors that have come through, and this is not a new topic, but it's certainly a topic that gains more and more focus as we go, is ESG. And I wouldn't even separate the two now, in the sense that ESG is becoming woven into the commercial DD of a deal. And so that's a factor that's been on the rise in prominence for some time, and we expect that to continue.
And obviously in South Africa, Marc, there has been increased scrutiny from the competition authorities around public interest concerns as they relate to mergers and acquisitions. It's still very early days, I guess, to see how, under the new Minister of Trade, Industry and Competition, Parks Tau, the competition authorities will apply this particular condition. But how are you seeing this kind of competition and public interest scrutiny impacting M&A, and what are your expectations for the rest of the year and into next?
We expect, Michael, that the regulatory environment is going to remain stringent. You make mention of the new Minister of the DTIC, Parks Tau. I mean, he may have a very slightly different approach to his prioritization and focus in terms of the aspects of mergers and acquisitions. We remain encouraged, however, by what we've seen in the short period that Minister Parks has been in office. So looking forward, we are enthused and encouraged to see that there appears to be a more supportive business landscape in terms of regulatory oversight and really focusing on the nub of deals in terms of whether they be restrictive of competition or not sufficiently facilitating public interest.
And Marc, just to stay with you and to build on that as a concluding question, I think there is a lot of misconception about what M&A actually entails within the general public or even within your client base or at a political level. So if you could change one common misconception about the work that you do, what would it be and why?
There's a common misconception as to what it takes to do a deal. First and foremost, we would strongly advocate any party that's considering M&A to get the right people in the room right from the get-go. The preparation and planning that's required is typically years in the making and not months in the making. So I think the common misconception with M&A is that it happens overnight, there's an announcement, and then it's up to regulatory approvals. That's certainly not the case. There's a lot of hard work that happens very early on from the genesis of an idea into ultimately delivering into a successful transaction.
Fantastic. Well, it's been great having you on the show. That brings us to the end of today's episode of the Monocle Banking Podcast. Marc Ackermann and Ruven Naidoo from Investec sharing great insights into the outlook for deal making in South Africa, which is improving, as well as the broader region. And it's clear that obviously while there are challenges that are remaining and while we do have to wait and see for some of those deliverables from the GNU, there's also a significant opportunity on the horizon. And I'm probably about as hopeful as I've been on M&A for the last 10 years. So I certainly hope that it does translate. As always, if you've enjoyed this episode, please subscribe to the podcast and leave us a review. You can find more content and insights from Monocle Solutions on its website and across its social media channels. I'm Michael Avery, and until next time, stay informed and stay ahead in the world of finance and business.